Good morning, and welcome to today's Moss Adams webcast, California Disaster Relief, Residency and Tax Considerations. Before we begin, I'm going to play a brief housekeeping video.
Welcome and thanks for joining us. Moss Adams webcasts are designed to help elevate your business performance. Transform your future for the better with advisory solutions tailored to your vision and supported by our collective technical resources. Our presentation will start in a few moments. Before we begin, here are a few things to keep in mind. You can customize how you both view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can also adjust window size and placement or enter full screen mode using the controls at the top of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons, each relating to a different aspect of our session. You can download a PDF copy of today's slides from the slide deck and handouts widget. You can ask our presenter questions during the webcast by typing a question in the Q&A window and clicking Submit. We'll do our best to answer all questions during the presentation or follow up via email. If you experience technical difficulty during today's presentation, refresh your browser by hitting the F5 key. As a reminder, the presentation you're about to see is not legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
I'm pleased to introduce today's presenters from Moss Adams: Chris Parker, Partner; Renee Bartlett, Senior Manager; and Estrilla Booth, Senior Manager. And with that, I will pass it over to Renee to get us started.
Thank you very much, Talia. So today's agenda, I'll speak first about calamity and disaster property tax relief, followed by Estrilla Booth, who will discuss casualty loss and disaster tax relief, and then she will hand it off to Chris Parker, who's going to discuss considerations for residency transition. So as I just mentioned, I'm going to be discussing calamity and disaster property tax relief as it relates to the 2025 California fires. So let's reiterate what happened. And in fact, yesterday was the 3-month anniversary of these disastrous fires. So on the evening of January 7th, 2025, these fires erupted in the Pacific Palisades, Malibu, and Altadena regions of Los Angeles County. And for those of you who aren't familiar, Altadena is a community that's directly east of Pasadena in the foothills. So these fires were started by the hurricane force winds, coupled with, of course, we're always in a drought in California, so we have very dry vegetation. And the embers that were produced by these intense fires also traveled great distances and ignited additional fires. And let me say something else. Although the Palisades and the Altadena fires were the largest and probably the ones that dominated the news, there was also fire in Ventura County. So what I'm going to say today, the calamity and disaster, or misfortune and calamity, applies to whatever county you happen to be in. So, excuse me. So we had evacuations, we had power outages, we had curfews. All of that was mandatory in these regions and for the surrounding neighboring cities. I happen to live in La Cañada, so we were adjacent directly west to the Eaton Canyon fire. That's the Altadena fire. Our whole city was evacuated. Luckily, nobody in the city of La Cañada suffered any damage, but we were evacuated. We didn't have any power. There was a curfew. So this was, you can imagine how devastating this would be for all of the immediate surrounding areas outside of the fires. So these fires continued for several weeks. The cause of the fires is still under investigation, although I hear that the Eaton fire, which is what affected Altadena, was probably, maybe, caused by SoCal Edison lines that sparked and ignited fires. And I heard something to the effect that perhaps arson was the cause of the Pacific Palisades Malibu fires. So in total, these fires burned over 41,000 acres of land and destroyed upwards of 13,000 structures and caused, billions of dollars of damage, as you can imagine. So what happened next? So because of the amount of devastation, on January 16th, 2025, the California governor issued Executive Order N-1025, proclaiming a state of emergency covering Los Angeles and Ventura counties. So what this did, in essence, was it extended the property tax deadlines, giving taxpayers in select zip codes until April 10th of 2026 to make property tax payments and to file their business property statements. So normally, the tax bills would have had to been paid by April 10th, tomorrow, and the business property statements would normally be due May 7th, 2025. So people in those zip codes that you see on the screen were eligible for the postponement until April 10th to make property tax payments of 2026 and file their business property statements. So Revenue and Taxation Code Section 170 covers misfortune and calamity, or calamity and disaster. That's the same thing, just different terminology. So the damage or destruction may be the result of a disaster that caused the governor to proclaim a state of emergency, and it may be the result of other types of disasters. So this section of the Revenue and Taxation Code would cover this is in California, cover fires, floods, wind, earthquake damage, or any other kind of a disaster that would, affect property value. So the total damage to the property, including land improvements, structures, business personal property, mobile homes, boats, and airplanes, must exceed $10,000 in current market value. And of course, if your house burned down, no problem, you're certainly going to qualify. And even if you have, extensive smoke damage, you can still file a claim form. So this is the important part. The application for misfortune and calamity must be filed with the local assessor, and in this case, we're talking predominantly about Los Angeles and Ventura counties, within 12 months from the date of the damage or when the destruction occurred. So filing a misfortune and calamity claim form. So this serves two basic purposes. First of all, it puts the assessor on notice that you want the property to be reappraised, the property that was damaged or destroyed by that calamity. It needs to be reappraised, and it also allows the tax collector, treasurer, to ensure that taxpayers who pay property taxes directly, not through an impound account, can defer their current year property taxes without incurring penalties. And I've read and heard lots of things about this particular disaster, and it seems like even people that have impound accounts can work with their account holder to maybe not have to pay the taxes timely without incurring penalties. There have been a lot of accommodations made for those affected by these fires. I'm sure you've read about a lot of it. So filing the claim form also prevents the need to file a separate penalty cancellation request with the tax collector's office. The misfortune and calamity claim form can be submitted online, or you can download the form and mail it to the assessor's office. Now, this is going to be very difficult to read, and that's not the reason I show it on the screen right now. The reason I show it is this is the form. It's 1 page long. It's not difficult to fill out. I think that perhaps, you can just fill out the form and submit it to the assessor's office, but what would probably be very helpful to the assessor would be for you to attach any kind of documentation you might have, maybe from an insurance company, photographs before and after, those types of things that will help the assessor identify the issues at your property. Although, believe me, they've been out there looking at these properties and trying to wrap their arms around the extent of damage that was done to these communities. So what happens next? So when the assessor receives the claim form, they process it. If a reduction is granted, the reduced value remains in effect until the property is fully repaired, restored, or reconstructed. If the full cash value of the new replacement improvement is within 120% of the property's pre-damaged value, not size, value. And what we call that is substantial equivalent to the structure or the property before the fire. Okay. Then the trended base year value of the prior damaged or destroyed improvement will be restored without any adjustment. If the full cash value of the replacement property exceeds 120% of the property's pre-damage value, the amount of full cash value above 120% is added to the destroyed improvements trended base year value. So this is probably going to be sort of a problem because due to the age of many of the affected homes, coupled with rising property values, delays, and rising costs of construction, it's anticipated that many homeowners will not qualify to keep their pre-damage tax base under this standard. But still, remember, even if you go above 120% or above substantial equivalent of the property before the fire, you'll still get the base year value, trended base year value. Then they're just going to add the incremental increase above that 120. So, and this is a cautionary thing right here. If a property owner uses the rebuilding process as an opportunity to build beyond the substantial equivalent of the original property, those additions will be assessed at market value and will be added to the reinstated original tax base year value. So once the claim has been approved, the Auditor Controller's Office will recalculate the secured property taxes, and the tax collector treasurer will issue adjusted annual secured property tax bills. The adjusted bills will reflect the assessor's reassessment of the property's value, if they've made an adjustment, and the property tax amounts due may be less than those of the original bill you received in October. And when I say October, I mean October of 24. So the secured tax bills that the second installment is due tomorrow were for the 24-25 fiscal year. So the adjusted bill may be payable in 2 installments. The first installment will be due at the end of the month following the date of the issued bill, and the second installment will be due 4 months later. So this is probably the most important slide in my presentation. So you can submit your claim form online, you can check the status of the claim, and you can also contact the Los Angeles County Assessor's Office if you have questions, just general questions about disaster relief for whatever kind of disaster you're having. So I've shown the link for the claim form. The Assessor's Office has been very, very, very good about rallying around this immense event. They have set up an email address, which is on the screen, and a specific phone number for you to use to call them or make any kind of inquiries if there's confusion about what you should be doing. They are very proactive about dealing and assisting the public with this, with this devastation. So as you can imagine, this is unprecedented, and so they rallied quickly and bolstered their misfortune and calamity unit. And like I said, there's a specific email address just for questions about misfortune and calamity. So the assessor's office has already put out several actual physical live events in the communities. I don't know of any that's scheduled right now. They also have some great videos online that you can access that discuss various issues that pertain to the misfortune and calamity form filing, etc., and additional resources for help. So with that, I will now, unless there are any questions, I'll turn it over to Estrilla Booth, a senior manager in state and local tax, who will discuss casualty loss and disaster tax relief.
Thank you, Renee. I appreciate that. As Renee talked about the property tax and how you can get your claims in for that, I'm going to focus more on the IRS and the state deductions that you can have. So first, for those of you that are on this webinar listening, and if you incurred an actual loss of your home, I just want to personally say I'm sorry for your loss of your home, and hopefully things will get better for you. I want to talk about the benefits. First, let me talk about what is a casualty loss. A lot of us we're fortunate for not to have to file one of these, so you may not know what the requirements are for that. So I just want to go over a little basic of what a casualty loss is for federal. So casualty losses, they are providing relief to an individual or a business that suffered property damage for destruction due to unforeseen event. And of course, these Los Angeles fires were unforeseen. And this goes under the IRC code of 165, which California does follow this code. So a lot of the stuff I'm going to talk about over the next few slides are about federal, but California does follow these, and I'll reiterate that towards the end. But first thing, to qualify for a casualty loss, and this is something that's normally deducted on your Schedule A of your personal return. For businesses, they would deduct it on their business return. First thing, it has to be a physical property. So it has to be tangible property, such as your home or your place of business. It has to be an identifiable event, so such as a fire, and I'll say earthquakes. California doesn't seem to have a lot of hurricanes, not at all, but that is listed there because that's one of the events that's mostly towards on the East Coast. Sudden and unexpected and unusual, which means that it can't be gradual over time, and it can't be, and it also has to be, it cannot be considered wear and tear. So it has to be sudden, which the fires, even though it lasted over a few weeks, it wasn't a sudden event, so it did qualify. As again stated. And also I forgot to mention floods as well. And we've had some disasters in the past that were related to flooding that was declared a disaster as well. So some of the record keeping that you should do for casualty loss, if you do happen to claim this on your tax return, is that you want to make sure that you have good records. And it's always good to keep photographs of the damage. These are not things that you would have to submit with your tax return, but it's something that you should keep on file. Photos of the damages, repair estimates and appraisals, receipts for the repairs, and copies of your insurance claims and your reimbursements, because the reimbursements are going to reduce the casualty loss. And we'll talk about the calculation in a minute. One thing I wanted to add is that if you haven't suffered a loss of your property or your home, it's always a good idea. We used to say this a long time ago, that you should go through your whole house and videotape everything you have, or take pictures of most expensive things and keep it in a safe deposit box, not necessarily in your house, because if the house gets destroyed, that gets destroyed with it. So you want to keep, if you have a chance to do that before anything happens, and God forbid anything happens, but just to have record of that kind of thing, keeping receipts of most things that you have that are valued. A lot of things are covered by insurance, but sometimes you have to show the insurance company what you had just to prove, that you had it. So one of the calculations for the casualty loss deduction is the lesser of the decreased fair market value before and after the event, or the adjusted cost basis. So Renee just talked about, you can file a claim for property tax for your reduction in your value. So your value of your property will be reassessed, and you'll pay a lot lower property tax. But for income tax purposes, you're limited on your casualty loss to the lesser of. So For example, let's say your cost of your house, you bought it for $100,000 and now it's valued at $500,000, but because of this casualty loss, it's only worth $300,000. You would have a loss of $200,000, but you're limited to only the $100,000 that you paid for the house. You can't take more of a loss because the value of a market, and I'll talk about that in another slide, that the decrease of the market value does not qualify as a casualty loss. Reduction of, and you're also going to reduce the casualty loss when you're calculating. You're going to reduce it by the insurance or other reimbursements, as I mentioned. Insurance, that's the obvious. Other reimbursements is sometimes not so obvious. If there's a prospect of recovery of expenses that you lost, the IRS and the franchise tax board would prefer, and they kind of, I can speak from experience, that they don't allow you to take the loss if you have a prospect of recovery. So, and we'll get into when you can claim the loss, but prospect of recovery would be example. I remember some years ago when I was the auditor of the state, there was a mudslide in Anaheim where the people lost their homes and it was sudden, and but they had insurance, but they also had a class action lawsuit, which was going to settle in a couple years later. So they weren't really allowed to take the loss. People were taking the loss, but then they had this prospect of recovery where they were reimbursed for their loss a couple years later. So there was like a big audit of trying to make them go back and adjust their returns to take it in the right year. So we'll get into that in a second. But I just want to just reiterate that what doesn't qualify for casualty loss is that it can't be wear and tear. It can't be, of course, voluntary. Now, what Renee was mentioning, yeah, there are such investigations going on, and it has been said that it was intentional, or there were some acts of fraud, or what is the word when they're trying to set a fire? That's not you personally. That's if somebody else did that, that's still unintentional for you. So you would qualify for the casualty loss. A market decline is not a casualty loss, and non-tangible losses, like, a lot of us are emotional when we lose a lot of something, of value to us. And so that there's no loss for emotional distress or anything like that. And believe it or not, they actually have to say that in the code because people will try to claim that as a loss. But there are some special considerations for federally declared disasters. And I want to also reiterate that casualty loss and disaster losses, you're going to get the same effect of a deduction, but the disaster loss, when it gets federally declared as a disaster or state declares a disaster, there's some extra benefits that you can receive as opposed to just deducting the casualty loss. So even if your area or you had a loss in a fire, like let's say you live in the Inland Empire and you had a loss and it wasn't declared as a federal disaster, you still will get to deduct your casualty loss. You just won't get the extra benefits that I'm going to talk about in a couple slides. So for the federally declared, it is designated by FEMA normally, and then it's there's an election that you can deduct the loss in an earlier year. So that's one of the benefits. And then there's a publication 547 that's out, that's a known publication. It gets updated annually if there's any changes. Right now, it currently reads that for the federal disasters declared between January 1st, 2020 to February 10, 2025, I was in there. Disasters incidents period that begin on or after December 28th, 2019, and before December 12th, 2024, and then disasters ending no later than January 11th, 2025. So that's confusing because we all know the fire started January 7th, and I think they're didn't end around January 25th. So what IRS did do is they did update on their website. It does say clearly as of February 11th, they did include the LA County fires as part of a federally declared disaster along with California. So you will get the added benefits. And the same with, as I was mentioning with federal, California's the same way. The casualty losses, they have to be, if they're not repaid for the damage of property, your casualty loss would be like from something from an earthquake, fire, et cetera. For California, any disaster losses that are between 14 and 2029 that you're able to claim those losses. A benefit, let me go over how to claim the California loss. California is very specific. I don't have a slide of the contact, but if you go to FTB website, actually it's at the top of the website, and you click on the disaster loss, it gives you the details on how to claim your loss. So you're going to put, for LA County residents, they are afforded extra time to file their tax returns. So on your tax return, and most people, I laugh at this a little bit because it says, to print your tax return, right on there in blue or black ink, that is a disaster. This is what disaster is. For this particular disaster, it's code 157. The reason why I laugh at that a little bit is because nobody prints their returns anymore. Everybody e-files their returns. So if you are e-filing your return, there should be instructions in your tax software or for your accountant's tax software that directs them how to make sure that they're putting that they are claiming the disaster loss. But like Renee showed you with the zip codes that are qualified for the property tax, California has where all the zip codes in LA County would be qualified, but I still would do that step to put that you're doing the disaster, claiming the disaster loss, only because sometimes you'll still get a notice, even if you're in the zip code of LA County, you may get a notice that you paid your taxes late, even though it qualified for the disaster. So one of the other things you would do is you would put the year of the loss, and you would include a statement of your documenting what you lost, and then you would also include your federal tax return. The option to amend a prior year, right now we're filing for our 24 tax returns, and this loss happened in January 25. So you would think, okay, I can claim this loss next year on my return in my 2025 tax year. The fact that and that would be normal for a casualty loss. The fact that it actually got federally declared as a disaster loss, it gives you the option to say, oh, you know what, I'm going to take this loss in 2024. I would highly recommend that you speak with your tax professional or the person that prepares your returns to see if it's a benefit to take it in 24 as opposed to 25. See if it's going to give you a refund. Another caveat I would say is might be best to wait and see, because you don't know what all your reimbursements are going to be from your insurance. Maybe not yet, you'll find out later. Another benefit, and this is just me reiterating that the IRS did go ahead and declare this as a federal disaster on February 11th. There are additional, and it doesn't sound like this is giving you anything by saying you have till October 15th to file. And people are probably thinking, well, we always get to October 15th to file if we file an extension. Well, filing an extension for return never did extend the taxes to pay. It only extends you to file your return, but your taxes are always due on that extension date, whether it be a business due March 15th or personal due April 15th. With the disaster declared for LA County residents, everyone in LA County would get to file their return and pay any taxes due between January 7th and October 15th. They would get to pay it on October 15th. So that would include your personal returns that are due April 15th. If you had an S Corp or a partnership or any business entity that's due on March 15th, that would be, you wouldn't have to pay that till October 15th without penalty and interest. They will be waived. And like I said, FTB, we gotta love FTB. They love to send computer generated notices. So even if you get a notice and you know you qualify for that, you definitely want to call FTB right away and say, hey, I qualify for this. You guys gave me a penalty. And 9 times out of 10, they'll just refund it. Waive the penalty right away. So I don't recommend paying those when you get those. Call first, because once you give them the money, it's like Fort Knox trying to get it back. But this is some of the benefits for payroll, excise tax, estimated tax payments that you would make. Those are extended, as well as pass-through entities tax payments that you would make. Those are normally due by June 15th. You would have till October 15th to make that payment as well. Already back to Chris. I just wanted to add a couple of things that I think that people might have a question on is if you are in LA County and you did not actually incur any problems with the fire or didn't have any effect, FTB, you have to prove that you had some kind of loss. You do not. If let's say you're in Long Beach and you had no fire, because you're in LA County, you were affected by the fire. Just like Renee said, people lost their power, people, there was things going on where they didn't have electricity. And so they made it all of LA County, whether you were in the fires or not, were attributed to having be able to declare disaster loss. So you'll get an extension on that. And then the other question a lot of people ask is, if I wasn't located in LA County, but my tax preparer was, will I still be able to get the extended because all my tax records are there? And that answer is yes as well. If your tax preparer is located in LA County and your tax records are there, then you would be afforded the disaster benefits for taking your tax return or actually filing or paying. One caveat with that, when you're dealing with a big firm like Moss Adams, and if you're saying that your tax preparer is in the LA office or your Moss Adams prepares your return, but your tax preparer is really located in Washington, you just gotta be caveat of that you might have to show proof that your records were located in California or in LA County where the disaster occurred. So with that, I'm going to turn it over to Chris, where he will talk about the residency transitions.
Thanks, Estrilla. Thanks, Renee. Appreciate your insights and your comments on the property taxes and claiming a disaster loss. Some of the questions our clients have been asking us are, what if I want to leave after this? I'm not sure that staying in LA or staying in Southern California makes sense for me in light of everything that's happened, possibly already thinking about leaving. And now this event has pushed forward and made that a very real conversation. So one of the factors that folks need to consider is the insurance coverage is usually replacement value of the property, not fair market value of the property. The replacement value is what the insurance company estimates it will take to rebuild to what the property was before. There is often coverage to enhance the property to keep up with current codes. Many of the properties in the Palisades were built in the 60s and 70s. Building codes have changed since then substantially, which means that there needs to be some additional investment in increasing the property to be consistent with current codes. That coverage still will not equate to the fair market value of the property, because that fair market value is based on a number of factors outside of just the physical structure and the beauty of the home that is rebuilt. Another consideration is the mortgage. California, for the most part, has non-recourse mortgages, which means that if you were to walk away, that you are not responsible for the ongoing mortgage payments. There is, after the 2008 and 2009 recession, a number of protections for homeowners so that the bank cannot immediately foreclose on the property. That means that the process of walking away from your mortgage is probably in excess of a year to go through. While that property is still in your hands, you are still responsible for anything that happens to that property. So if there are folks who come onto the property either to assist in damage recovery, remediation, or because they need to access a neighboring property and they get injured, that would still be some level of responsibility on you. There would also be any remediation issues would still be potentially subject to your expense. And so it is not just as easy as saying, hey, I want to walk away and be done with this. There are some considerations. If that is something you're considering, we encourage you to reach out to your lender early and start having that conversation as soon as you can. The cost to transition versus the cost to rebuild. The folks who are looking at leaving the LA area are looking at a variety of locations. So there is maybe a substantial cost to looking at those other locations. If you're not going to use those insurance proceeds to rebuild, that needs to be communicated to your insurer on what you're going to do with the property, because they're still looking at that property as your personal residence. If it's been held in a trust, then you would need to have the trust documents and look at what is available in terms of the trust and managing the property under the trust ownership. Potential future risks in the area includes looking at how the area will be rebuilt, and that is still something that is being considered. LA City, Los Angeles City website has a lot of detail on LA Strong and the recovery efforts. There's also some commentary on changes in zoning and changes in potential future use of the property, including new transit into the area that would change the nature of the neighborhood and may change how people view the neighborhood going forward. That could have potential future impacts on high density housing and other types of housing in the area, other commercial use in the area. Because there was so much destruction, it's the first vacant large piece of property in the LA area in a very long time, and that is causing some of the government agencies to look at whether or not the rebuilding should be as it was or different. Timeline for repairs, this is weighing heavily on a lot of our clients, oftentimes trying to find a quality contractor to connect with regarding repairing and rebuilding the property, particularly if it was partially damaged and not fully damaged, is very difficult because there are only so many contractors available to assist with recovery efforts. A lot of the properties are still quarantined because of remediation efforts and hazardous materials as a result of the intensity of the fires. So that timeline for repairs is something that is a factor that you may want to consider. A number of clients are finding that the repairs are 18 months to 24 months out of the current time frame. That is an incredibly long time to be without a home, and that is weighing on folks as to whether or not they want to wait for that rebuilding or they want to look at another option. Children's age and emotional well-being is also, of course, very important. A lot of children's friends have been moved, schools have been damaged or completely eliminated, and understanding how to work with your kids on what that means going forward for them, their friends, their teams, other programs they may have been involved in. All of that is an important factor and something to consider as you're going forward. Financial assistance programs, you've already heard about the programs from the property tax and income tax sites. There's also unemployment insurance assistance and other insurance assistance programs. Again, LA Strong, which is the Los Angeles City website, has a lot of those already linked and available information on that. We've already heard a good conversation on taxes. One of the things to think about if you are rebuilding is there may be a change in your basis in the property depending on what you build. There may be income tax implications if you sell the property and how it's sold. So all of those would factor into why somebody may or may not want to leave. The other things that should be considered going forward, if you are going to put the home into a trust, you're going to want to make sure that the trust is identified as an insured on the property, which means that you want to have the trust be able to recover insurance proceeds from that policy if there are future actions against the property of any kind. The mortgages will obviously be something that need to be addressed on a go-forward basis as well. How is that going to change? And then looking at what you want to do with rebuilding. Renee already talked about the rebuilding beyond what was already on the property may have property tax implications as well. That folds in well with what is the realistic time frame for rebuilding. Some clients have already been exploring remediation. They're getting quotes that are remarkably high, $250,000 to $500,000 for remediation efforts for those who were in the fire area. The home was not completely destroyed, but there is toxic ash and other toxic chemicals that have gone into the home that requires very specialized contracting and very specialized skills to eliminate those and allow the property to be entered by people who are not in hazmat suits. We're also getting the question on whether it's a good time to sell. Those homes that are near the fire zone but were not directly impacted by the fires are suddenly in a very prime real estate area because people who were in the Palisades or in Altadena don't necessarily want to leave the area. So some of those folks are getting very remarkable offers over fair market value to sell their homes. They weren't ready necessarily to sell, but now that question is coming. Obviously, a sale is usually a very easy exit from a property if that's something you want to do in terms of the financial impact. The emotional impact and the emotional connection to the property are certainly something to consider. We're also seeing those clients who are looking at renting in the area are seeing some very exorbitant rental rates for properties that are near the Palisades, near Altadena, and near Malibu. If you are consider look at a larger geography and evaluate whether or not that larger geography may make sense for you and your family. That is also, of course, leading some clients to consider exiting the area because when they start thinking about that larger geography, it pushes them to think about areas outside of LA County and outside of Southern California. This has already been mentioned by both Renee and Estrilla, and I want to reiterate it here. The gathering and maintaining documentation is super critical, not only for everything that may have been lost in the fires, but on a go-forward basis, being able to document what was recovered in terms of insurance, what was not recovered in terms of insurance, any collectibles, partial damage to properties. All of that information is going to be critical. The returns, when they're filed in California, have a 4-year statute of limitations. So there is that necessity to prove any claimed losses. And then you've already heard from Renee about the property tax relief deadlines and extensions that are available there. For those clients who are thinking that maybe moving out of California is something they want to consider, we do have a residency transition webcast that's available to you. It's on our website. It's free. And you're certainly welcome to take a look at that if you would like to talk to somebody about moving out. Happy to have that conversation with you. Of course, we understand it's a very difficult conversation to have in light of everything that's been going on, but we want to be available to those folks who are considering moving out. And then finally, I want to talk a little bit about some other residency transition key considerations. You really do have to uproot your life and not necessarily spend a lot of time back in California if you are going to exit California. For those folks who lost their home, that may already be something that they're thinking about heavily because of the tumult that comes with losing your property and losing 20 years. So it is something to consider in terms of your income, what's going to happen with your employment. If you have a business, what's going to happen with your business in the area, what's going to happen with those. All of those are important considerations as you're thinking about transitioning your life to a new jurisdiction. And finally, some of the risks of residency transition. FTB is incredibly aggressive with residency exams. Unfortunately, the budget situation in California means that FTB is examining days. So that's leading. Those audits are typically on the more aggressive side, more intimate in their detail, in the sense that they're asking for a lot of personal information. They're asking about doctors and dentists and where your kids go to school and where your pets go to the veterinarian. Those are all very personal questions. And with the transition that may be occurring because of the loss of the home, some of that documentation may not be available. It makes it even more difficult, more frustrating for clients to experience. So with that, I think we would like to conclude our webcast. We want to make sure that we communicate that we're available for any future questions that you may have. And thank you so much for all of your time today. And so, Leah, were there any questions that you wanted to cover with us?
Yeah, absolutely. It looks like we do have time for a couple questions here. One of them is, if I've had to move out of my home for an extended period due to the damage or destruction of my property, how will the assessor know where to send any correspondence?
Good question.
Great question.
And of course, yeah. And Chris just mentioned this. You know, if your house burned down and you have to go you obviously have to go someplace to live temporarily, or unfortunately for some of these people, it's going to be a long haul, right? So you're going to try and rent a place, or maybe your friends take you in, but you need to have obviously a method to continue to receive important documents, particularly from the government, because we all know if you don't get those, they don't care, right? So for property tax, what you do is you can go to the Los Angeles County Assessor's website, and under homeowners, there is a link for changing your mailing address. And I encourage you, if you've been displaced, even if it's just for a couple of months, change the mailing address with the assessor's office. And then generally they can, I think, forward that to the tax collector's office so that their records are also updated. Generally, whatever the assessor has as ownership and mailing address in their records is what comes out on the tax bill. So change your mailing address soon.
Thank you, Renee. I think there is another one that is probably directed towards you as well, and it's, are there any other resources for additional guidance relative to California calamities and disasters?
Yes. Aside from any local assessor's office, and like I said, LA County, there's a big splash on the front page to direct you to the misfortune and calamity page and all the resources they have there and forms, etc. But you can also go to the California State Board of Equalization website, who also has a splash across the top of theirs about disasters. And there's some very useful information there that would be helpful, not just for, well, particularly for property tax in this instance. And I'll let Estrilla and Chris chime in if they've got some recommendations for places to get additional information about their particular subject matter.
Yeah, Estrilla, you want to talk about the FTB website?
Yeah, so just to mention again, it would be F as in Frank, T as in Tom, B as in boy for ftb.ca.gov. If you click on their link, actually across the top is a yellow banner that literally says, for California provides tax relief for those affected by the Los Angeles County wildfires. And if you click on that link, it goes into detail about when your tax returns and tax payments would be due, how you got the extension, and how to claim yours. And there's also a phone number on that website and an email address as well that is specifically for the people that are affected for LA County, that you can relate to or refer to on that of the website. And then also with the IRS, their irs.gov, also across the top for any kind of disaster for federal, because there's a lot of disasters going on right now, not just LA County. There's like the hurricanes on the East Coast that are also on there. So specifically for LA County, I would refer to the Franchise Tax Board website. If you have any other disasters you're interested getting clarity on, I would go to the irs.gov.
Yeah, and I'll piggyback on that the question regarding changing addresses. Both the FTB and the IRS have online individual account access after you go through security verification. So if you do need to update your address information or update other information, you can do that online and enable them to communicate with you via email, and rather than just mailing communications to your prior address.
And then to add to that, Chris, also you can go to the USPS website, and you can, if you don't already have an account set up, I would recommend setting up an account and stopping your mail from going there or changing your address. A lot of government forms are usually not forwarded, so it's better to put a note in the USPS that you want that that your mail stopped and that you would pick it up from your local post office. That way you can make sure you don't miss any other documents that are places that you forgot to change your address with. That's another alternative to make sure you get your mail.
And I'll give the California State Board of Equalization website is boe.ca.gov.
Thanks, Renee. With that, Leah, I think we turn it back to you.
Awesome. Thank you. Thanks for sharing your insights, everyone. And thank you, Chris, Renee, and Estrilla, for a great presentation today. If we didn't have time to answer any of your other questions, we will do our best to follow up with you after the webcast. Here's a link to an online survey where you can provide feedback for today's presentation. Please take a moment to complete this survey, as your feedback is very important to us. Please also visit mossadams.com for future webcasts and other resources to help elevate our performance upward. Thank you for joining us, and we hope you'll join us again next time.